Hello everyone, thank you for attending our webinar today. Let's welcome our speaker, Mr. Jeremiah Ong. He is a professional investor with 15 years of experience specializing in equities, index futures, options, spot forex, and commodities. His experience includes but is not limited to being a director in MNC companies. Today, he will be sharing about how to use benchmark index as a reference and price action techniques to identify potential reversal points. On top of that, he will share how to use buy on dip strategy to improve entry and exit points and how to use moving average to determine value trap. Let us welcome Mr. Jeremiah Ong.
Thank you for your kind introduction, and thanks for everyone who are joining us today. And I hope you can take away from this webinar something useful, and how I approached this webinar was something that the experienced investors and new investors will probably find it beneficial. So some of the materials covered will involve simple stuff, simple things, and maybe a little bit more advanced. However, I think it's useful for everybody. So before we begin, please take a minute to read through this disclaimer. Okay, so let's go on. Okay, so the key takeaways today that I hope everyone can learn from is how you find high quality data. Before you even determine where is the buy and sell points, right? You have to understand where to find high quality data and where are all the research materials that you can benefit from. And of course, I'll go into the fundamental analysis, first looking at the market, and then how you determine the market sentiments. So valuation and sentiments are two separate things, but they are very, very critical to understanding the market and where the current direction is. And I also go into the things for the day, the buy and sell points, particularly for position trading and investing. So those who are short-term traders, day traders, this will not be useful. So this is mainly for long-term investors and position traders. So I'll go into price action and trend analysis. So this is not technical analysis, right? This is price action analysis. So that you understand where are some of the optimal entry points from the charting point of view, and also some of the key technical indicators that I use. Now, while this is optional, if you want to include this in your approach, because I don't use this anymore, right? So, but I'll share with you some of the technical indicators I used last time. Okay, I think you can't share my screen. Let me just let you see. Can you see my screen now? Yeah. Okay, so sorry that you didn't manage to see this some of the points that was covered. So these are the points I was covering. Right, high quality research, FA for market valuation and sentiments, the sell points for technical for fundamental analysis, price action and trend analysis, and the technical indicators, which I'm saying is optional. And also importantly, how to determine value trap. Right, what are some of the stocks that you don't want to go into using fundamental and using trend analysis. Right, so if you have any questions at any point in time, please just leave them in the chat box. I will try to answer them either during or at the end of the webinar. So just a quick profile of myself. I'm an independent investor, focusing on the equity markets, futures, options, and spot FX since 2018. So, but my journey started since 2005, so it's more than 20 years ago. So 15 years ago, so I experienced the great global financial crisis for 2 years, where the average decline in the index was about 57%. So nothing scares me anymore, right? After going through that, nothing scares me anymore. And I use price action techniques, fundamental analysis, and some little bit of technical analysis in my approach as well, for both my trading and my investing. And if you want, you can follow me on LinkedIn. This is my LinkedIn profile. I do post updates and ideas there regularly. And of this is the next one is from one of the participants previously. They asked me to set up a private Telegram group for updates and two-way sharing. So I'm considering that. So if you want to actually be part of this group, you just leave your name and your email in the chat box, and then we will add you in subsequently. So just a quick snapshot of the portfolio performance, just to give an idea of what I'm doing. So the first box here is my swing trading and position trading. So you can see this is the duration of the portfolio for this And I'm showing the P&L from the bottom. You can see if you actually take advantage of the opportunity that came from the bottom, right? It's very, very profitable. And in fact, some portfolio for my fellow traders, they even hit 300, 400%. So it's very, very profitable. This is my long-term portfolio. This is one that I just buy and hold. I don't sell anything. And the P&L is up 33% versus the index, which is just up 5% year to date. So you can see if you know how to use good investing methods and you know how to hedge the portfolio, you can actually benefit from it. And the last one is my non-directional one. So I also have a non-directional portfolio where I don't care whether the index go up or down. I can strategies do that. And I also use that to hedge. This is particularly just going to S&P 500 options. The holding period is 12 weeks. And year to date is up 21%. So be bear with me, there's some background noise because my neighbor is doing some renovation. So you can just be bear with me for a while. Okay, so key point here is now where to find high quality data, right? So before anything, you must be able to find high quality data. If you can, these are some of the information that the institutional investors use. Right? So these are the platforms they use: the Global Terminal, S&P Global, Capital IQ, Icon, FactSet. Then there's the next gen platform called Sentio, very powerful platform. I find it very powerful. It's really very good. They use a lot of AI, machine learning capabilities in this platform to deliver the analytics to the user. And of course, now the platforms that I say above is expensive. So if you want something more affordable to start with, you can consider Simply Wall Street, Finviz, YCharts, Market Screener, Poifin, which is free for now, a very, very good platform, and Business Quant. Business Quant goes into granular data. So you go into operational performance, you can see segment revenue, you can see comparable store sales, everything. So you can see very clear stuff, which is, I think, is very useful if you are going deep dive into a particular company. Now, then of course, besides the sell side, you can go to the buy side, right? So the buy side one, you can consider Motley Fool. They do deep dive. They have a webinar. I think they have a daily webinar thing, right? Some stocks that you want to cover, you can go into it. They do particularly bottom-up income investment thesis. And if you want buy-side articles, go Seeking Alpha, a very good platform. Now, if you like momentum investing, so you use Investors Business Daily, right? They can consider the leaderboard of Marcus Smith. They provide you information. They even give you particular buy points for this particular style of investing. And independent research Morningstar. Charting platform. So there are a lot of platforms out there. So I particularly like to use TradingView because you can create algos, you can create a lot of scripts, programs, to help you in your charting. Otherwise, you can use a broker. One of the brokers that I really think is very good is TD Ameritrade. Singapore, they also have one, so you can use it. The Think Option platform is one of the best. The option analytics is also one of the best that I see out there. TC 2000 has an excellent stock screener. So there's so many things out there to use. So which one should you use, especially for those who are not familiar or new to investing, right? So you want to start with something. Okay, so if you want to have institutional platform, really solid, very good one, and you want to have this data, right? So we can consider Sentio, but I think that this is particularly useful for highly experienced investors because you're paying quite a bit of money for the platform. It's about 8,500 US a year, right? So you have to find useful, right? You justify the ROI for it. I think it's a very powerful platform, very, very good, better than Bloomberg Terminal, right? So this is only for highly experienced investors. Now, if you want very high quality data, very good in analytics, right? You use Coifin because it's free, right? It's free, so free for now, and of course you need some knowledge of fundamental analysis, valuation in order to benefit from it. But you can learn it, right? So it's not difficult. You can learn it, so it's a good platform to use. And then you want buy-side research, that's good. Go Seeking Alpha. There's a free option to use to consider. You want sell-side research, which is a good one. You can just go TD Ameritrade, right? It's free as well. And of course, if you want easy analytics that's already done for you, give you an opinion, right? Go Simply Wall Street, right? They design all this to help investors improve their investment intelligence, which is very important because you have to seek alpha. You're competing against a lot of investors in the market. You need to have certain ways. You need to have certain platforms that help you to do that. So these are some platforms for stuff. Okay, and of course, price action charting just use TradingView. They have a free option as well. Okay, so going to valuations, the market right now, right? As you can see, this is we call it Buffett indicator. Why? Because he mentioned this before in 2001, where he thinks this is where he thinks the way of calculating valuations of the market at any given time. Right, the ratio he used is simply total market cap divided by GDP. In this case, it's a USA GDP. So at this point in time, the ratio tells us it's about 177.6%. According to this ratio, the market is overvalued, significantly overvalued. But it doesn't mean that overvalued the market will definitely come down. It doesn't mean, it just means that it's overvalued. So it's telling you it's harder to find opportunities to invest with a good margin of safety right now. That's what it actually means. It doesn't mean the market won't go up. Right? So this is where you can take note of what the current market valuation is currently at right now. And okay, just showing the left side of the chart, you can see using PE. So this is a Schiller PE. You can see here, currently at 32.4, 20-year average is 25.7. So we are above, we're quite significantly above the average right now. Right. You can see this is the red line, is the S&P, and this is where the PE, which Schiller PE is at right now. So well, we are above historical average. So we are, of course, not cheap. Valuation not cheap anymore. Therefore, like it ties in well with Buffett again. So there you have double confluence factor right now. So market valuations are not cheap right now. You have to find, you have to go dig deeper to find opportunities to invest. Now I want to show the chart on the right as well, because this is a standard PE. Why I don't use standard PE, right? You have a few reasons why. You see these gray boxes here, right? This is where all the previous recessions is at. This is the dot-com bust. This is the global financial crisis. Right? So you can see whenever there's a recession, earnings obviously will tumble, right down the drain. As you can see, this is the index, right? The red color line is the index. The black, this line here is the PE. So during recessions, especially for cyclical companies, they have very bad earnings. The PE goes up, right? Because the PE ratio is price divided by earnings, right? So at any point in time, you see, hey, it's a bad time to buy. Actually, if you look at where the index is, it's a fantastic time, right? Look at here. PE was so high, and then the index was right at the bottom. So the PE is not meaningful to me, right? Because it doesn't tell you when to buy. It even mislead you. So I don't like to use standard PE. I use Schiller PE in order to give me a good idea of valuation. Because Schiller PE, right, eliminates the fluctuation in the profit margin. Right, it's neutral, so it's very good to use. All right, so I go into sentiments right now. So you see valuation, I go into sentiments. I like to use this bull-bear ratio sentiment. This is exclusive to Investors Business Daily. It's a pop software telling you what is the current market sentiment. So at this point in time, the bulls obviously is very bullish, right? Bears, but the thing is, these are contrary indicators. Meaning that if the bulls are, you can see here 58%, right? You look at the previous history, whenever it's above 60, this is a line of 60, there's always a correction or retracement, right? You see here 60, above 60. I mean, it doesn't mean you see here it's above 60, it doesn't mean you're not going, you're going for a while, but after that, there'll be some sort of correction, right? Bring the sentiment down back a little bit to a safe area, and then you start to add again. Right? So sometimes the correction become a bear market, right? In this case, a bear market, right? It's all the way we know, right? And same as here, much that bear market. So this correction become a bear market. So as you can see here, the green line here is the bearish sentiment. Right? Interestingly, whenever the sentiment cross, that's where the market bottom is, right? You see? Sentiment cross, market bottom. So this contrarian thing is true, whenever the market is fearful, that's the best time, right, to invest. You basically multiply returns many years in a short period of time. So very powerful indicator for market sentiment. And then, of course, I also use this fear index. They call this the CBOE volatility index. It's a fear index. Basically, it measures volatility. Right? This is the words. Right? Just take it. It measures expected volatility. And it's very useful in determining market bottoms. So I can just give you an idea, like if the market is fearful when it's above 40, extremely fearful is above 80. So going to the charts, you can see, just take out those two periods, right? This is the global financial crisis, right? As you can see here, it goes above 80, right? This is the 80 line. And that's where we are very near the bottom. Right? We're very near the bottom. So, and whenever the market is above 40, you can see that above 40, there's always a little bit of retracement taking place, right? Above 40, retracement taking place. Above 40, you see retracement taking place, right? It goes down a little bit, right? And then here, same as well, above 40, it also goes down. Now, you may think this is very small. It's not actually, because this is a monthly candle. It means 1 bar equal to 1 month. If you go into daily, it's actually quite a big correction. And of course here, right, so you see this is the one in March. It goes above 80, extremely fearful. That's where the bottom is. So, very good indicator. This is useful for market bottom scenarios. You can see, right, the market is very fearful. You know, that's where the market probably will bottom. And then where the bad news is, so you stop reading the news because it causes you to make very wrong decisions in the market. Okay, so now you saw how to do market valuation and sentiment. Now you can go into how to look at stocks itself. Now the first thing you look at is the relative valuation. I like to use this valuation band, I call it, right? Price sales. Now the ratio itself honestly tells me nothing. I don't use the ratio because ratio is just a ratio, right? So it tells me nothing. But if you want to use it useful, with even if it's beneficial, you can use a valuation band. Where's the max? This is the max price sales band, where historically where's the highest of the price sales ratio over time, and this is where the minimum is, and the middle is the median band. Okay, so basically this ratio is similar to total market cap over GDP, the Buffett indicator that you saw just now, right? Especially useful for cyclical business as compared to price earnings, because you saw price earnings, it's not meaningful at all, right? It may give you a wrong idea. Okay, so you can see I use the Amazon chart right here using the price sales bands. So typically, whenever the band is in the middle, at the median line, right, it is fairly valued. Now, for a company like Amazon, fairly valued, good buy, right? Because Amazon is a wonderful company, and Buffett has said before, right, he will pay fair price for wonderful companies, right? Good buy, obviously. So, and whenever it's right here, you see is near the minimum band is amazing buy, because Amazon is it's an amazing company. So this is how you can look at the valuation band. This doesn't have to determine the entry point, but it gives you an idea of where is the relative valuation of the stock. Right? So at this point in time, Amazon is right up there, right, at the maximum PS band here. So according to this particular indicator, it is towards the overvalued side. So now Amazon's intrinsic value is actually much higher than the current price. So in terms of intrinsic valuation, they still have some way to go. But if you look at this band here, I won't buy here. I mean, the stock prices doesn't just go up because their target price is like 6,000, 7,000, right? The market don't go on the straight line. So they will go through periods of up and down wave pattern. So therefore, I won't buy it because it's at the max band. You see, based on history, right, previously, this was the December bear market. They always do some correction, right? So it's not. So I would, even though the entry value is lower, it's quite higher than what's current price is, I wouldn't buy it. Now this usually only used for non-financial firms. Okay. So financial firm, you use a PB ratio. Again, I don't use the PB ratio on its own because it's not meaningful, right? So I use a band as well, same thing. Maximum PB band, medium PB band, median. This is the minimum PB band. So you take a look here, right? Whenever it's near the minimum PB band, the price will always come back, right? Then it's fairly valued. This is Bank of America, BAC, and then here you see 2018, right? It's really at the top of the PB band. It's not to correct. See here again, March, right? At the top of the band, it's not to correct. So I bought a lot of BAC here. It was a fantastic company. You know, Buffett owns a lot of BAC. So now there's a caveat. Banks, right? You cannot just look at PB because there's a lot of other banks that PB ratios are very low one, right? So you have one important caveat is that the ROA, the return on assets, must be in the uptrend over time, right? It doesn't matter 1 year down. Just generally you plot it, right? It's an uptrend over time. It's very important, right? Then I'll go into it. Okay, so if it fulfills this criteria, okay, then you can look at this PB, right? So this is the share price of BAC. This is where the PB is. Bank of America is no longer undervalued. It's quite fairly valued right now. So for a good company like BAC, fair value is okay, right? This is not too bad, right? So it's fine. So I go into why. So this is the 2013 interview on Motley Fool with Buffett on how he value banks, right? So a lot of people look at banks just on PB ratio, but he said before, book value is not the key. Earnings are the key, right? So for this is the 2013 back then, right? So Wells Fargo back then was trading at a good PB ratio, compared to banks like BAC, because they have a higher ROA. So as you can see here, you can go to these, if you want to refer, you can go to this module article. Right, so just follow this chart here, right? So this thing here is the PB ratio for Wells Fargo, right? This was the PB ratio here for Bank of America. So you can see back then, right? Wells Fargo trade at a much higher PB than Bank of America, right? For some good period of time, right? It is like that. And then this line here is the ROA. And you see the ROA of Wells Fargo start to peak. And then you go into a downtrend, right? You can see over time go to a downtrend. Whereas Bank of America's one still continues uptrend. So then you can see that PB start to converge already. Right, until Bank of America took over Wells Fargo here at this period of time. Right. So right now, tellingly, you look at the PB. So who has a higher PB now? Oh, Bank of America. Why? Because the ROA is higher. I mean, so Buffett gives some this kind of snippets of his intelligence. You have to take note of it and then use it, and for your own as well. And if you go to the share price, oh sorry, this is not okay. Yeah, as you see here, right? So this is the ROA, right? Over time, it's going down, right? It's going down, circular downtrend. So PB very low, 0.7, right? Lower than BAC right now. So it's a good. It's below the minimum PB band. You see, it's so called very undervalued. But I also want to buy Wells Fargo. I mean, this is my opinion, because my first criteria is ROA must be going up over time. It doesn't matter 1 year go down, it's okay, but over time it's going up. So it's not high. But if you look at the share price performance over time, you can see when this is the ROA for Wells Fargo, this is BAC's ROA, right? So as their ROA converge, right? In the convert, you see BAC started to go higher already. So if you held BAC for 3-4 years, you have outperformed Wells Fargo. Right, so it's important to use this sort of analytics in order to give you some kind of to help you to improve your decision making, valuing this stock. Okay, so I hope we can see how using PB with the ROA gives you a very good platform to analyze banking stocks. Okay, so going back to after we've covered relative, I go to intrinsic valuation, and for a start, I mean, this is just a discounted cash flow table for the stock, right? And I was saying to you all just now, Amazon, I think this is the fair value right now. It's not fair. Okay, so and current Amazon stock is below fair value. So based on this date, then there's a 21% margin of safety. So for me, a margin of safety should be at least 15%. So at least 15. That will be a good entry point. So if you're a long-term investor, if you're a long-term investor, you can actually go because it's undervalued. So you don't mind that you're buying at a high of PS there, right? It's okay. It's undervalued. It's really okay. But for me, of course, I'm a price action investor. I always look at price first, then determine all the other things. So it depends on what your style of approach is. Right. So for intrinsic valuation, you can use a lot of methods, like DCF, discounted income, things like that. But this one is a caveat. You must always use it for predictable business. Right? So how do you determine this? The revenue and EBITDA must be constantly increasing, right? Consistent, very predictable. Because you are predicting their cash flow in the future, you need to have a company that gives you predictable one. Those are not, I better don't use this method because you will make a lot of wrong assumptions. Right? And then margin of safety at least 15%. Financial companies can use a sense return model or business income model, whatever it is. But I prefer to use PB bands because financial companies' returns are volatile. So they feel my predictability very good. So give an example, BAC you can see, right? This is the revenue. Generally uptrend, right? Okay. But you see their EPS. Okay, bank don't have EBITDA, so we see EPS. So you see EPS is cyclical, banks are cyclical companies, right? They follow the economy. So I don't want to use DCM on this side or use intrinsic valuation methods because yeah. So I think it's not useful for me. It's not so predictable. So I prefer to use relative valuation. I can compare to Amazon, right? Amazon very nice, trend. Look at their revenue, EBITDA, very nice. So yeah, very predictable. You can use a DCF. You will as long as Amazon maintains its mode. Okay, this is the assumption. Right? You expect Amazon to be able to hit your intrinsic value. Okay, So basically, when to sell, right? You saw when to buy, when to sell. Like for example, I was saying, now if you are now Amazon at this price here, right? Usually value is still quite high. But if you are somebody who want to open some profits, you want to take some money off the table, you rotate into more undervalued counters, right? Not a bad time, right? I mean, it's no right, no wrong. But these are some of the references you can take of how to determine to sell you, right? If he's right at the top, you sell, not wrong, right? Not wrong. Take some profits off the table, take some risk off the table. LMT, right? This is Lockheed Martin. You can see here, this is a security company. So whenever you reach the top here, you see this back in 2018, then it comes back down. Right? This is March this year, it comes back down. So based on history and how prices react here, valuation, it's not wrong. It's not wrong. Boeing. So you can see here, very near the max PS band here, right? Then it starts to come down. Because valuations are high. Right? So Boeing right now, how do I close? I have Boeing shares as well. I bought it as a top term. I didn't hold here. Some reason I didn't see Boeing back then. So good time, bad time. I mean, Boeing is not cheap because you can see based on the valuations above the premium band, it's not cheap, right? It is pretty fairly valued, but they need to improve over time. Right? If it's circular downtrend on the way, it doesn't really improve over time, then I think this is expensive. So, but right now, based on what I see, based on what target price is in the future, based on their expected revenue, as long as they can recover their revenue over time. So I think this stock is not fairly valued. More good stock like Boeing, good company like Boeing, has a very wide economic growth, very okay. So we have to see how it develops. This is Chipotle, right? CMG. So it's a bigger company, restaurant. You can see when you hit the next band here, they always do a correction, right? Next, correct. Okay, so okay, this is the period of time where it goes below the PS band. Right? So if you buy here, you can see. So that's all I say. This is not determining an entry point or exit point. It's to give you a sense of the valuation. Entry exit point, you still must use price action analysis on the charts. Okay, so but if you are near the bottom and you have time, actually you are here, you have long horizon. It's okay because over time, if CMG company can gain its boat, can increase its boat, it will go up once. See, if you buy here, you will still go up over time. Right, so I want to pick CMG because you see CMG before the crisis I was here. It was pretty fairly valued, right? It's not expensive, it's not cheap, it's just fairly valued. But back then, a lot of I have friends as well telling me, hey, CMG is expensive, very expensive. Why? Okay, I'll show you why. Because they tell me the PE ratio very high, right? You look at the PE ratio over time, wow, CMG is very high one. You can see here, even reach 100 before, right? 131 right now. Right now it's expensive, but if you look at the previous slide, you can see very nice. But previously it's very high, very high. As compared to all the other household brands like Starbucks, all the brands are here. You say, well, CMG is expensive. So WD stock is so expensive. But you see, PE to B doesn't tell. That's why I don't use PE. It doesn't tell anything because it's not meaningful at all. Right? If you actually, for this period of time, you actually help CMG compared to these three other counters, you will have more than outperformed them. Right? CMG over this period of time increased 230%, whereas the rest of them is just between 11 to 31%. So at the end of the day, you make money when the stock price go up, right? Not because you think it's undervalued or overvalued, so based on PE, right? So at the end of the day, you have to use this kind of analytics to help make a decision. So CMG, I told him CMG is not expensive. It's cheap. So it's fairly very expensive. So don't look at PE as a way of telling you it's expensive or something. Okay, so when do you sell based on intrinsic valuation? So you can sell when it's more than 20% above its fair value, right? You can sell it. For me, if the company is a good company, right? I see it's high growth company, has high relative strength. Usually, I will wait until it's 40%. But I probably will take some profit at 20%, and then I will take all, not partially cashing in, right? So then I will sell the whole position at 40% above the fair valuation. Even if the fair value is still here, like for example, if it's still 4,000, the things never change on Amazon, they didn't increase their cash flow and things like that, it's still at 4,000. And then suddenly the price for some reason shot up 5,600 at this one. So I was because it is significantly over. And when such things happen, they will always mean revert. Right? So this is how you can decide when to sell based on intrinsic value. Then you can hold cash or you can rotate to other stocks. Right? And when do you sell? Also based on fundamental analysis, when the economic mode is eroded significantly. So look at Hertz, HGZ, you know this firm that was bankrupt, right? Announced Chapter 11 filing earlier this year. So you can see Hertz actually has been not doing well over time. Their margins, especially look at the gross and the operating margin, right, has been in the long-term downtrend, right? It's not going. They're not able to recover the previous good days really. So for companies like that, when they cannot maintain their margin, it's long-term downtrend, you really need to be very careful. But if you want to buy, you must ask yourself whether can this company recover? Are there other profit drivers? So they must dig deeper. So this is just this gives me a red flag that if I want to buy this something else, this you need to think of this. Then right, so ExxonMobil as well, right? You see their margin has been going down over time, right? This one was really this spike here. I do like to see margins like that one because it's not consistent. It means this company cannot maintain its margin, its margin over time. Right? It's up down, up down. Not good. I don't like it. Right. So you can see here, right? Although this one went up across 25, the operating margin actually went down. So that's why you need to compare with both together. I don't like ExxonMobil. This kind of business is not good. Right. So this gives you an idea of what kind of how do you determine economic eroding over time. Okay. So now we go to the price section. Now, let's say this is only for precision trading and investing, right? Not for short-term trading. So you just plot your chart. Just make sure, just put a few things here. Right? So first thing is your 20 period simple moving average, your 50 period simple moving average, and 200 period, right? SMA. So the dotted line here is the 20, the blue line here is the 50, and the red line here is the 200. Right? As long as this is uptrend over time, as you can see, this is a weekly. It's a very long-term period, weekly candle. So 1 bar is equal to 1 week. Long term, this is a good stock. So this is actually an index. So the S&P long-term uptrend. And as long as 20 is above the 50 is above the 200, it's good. Right? So this is how you determine trend analysis. Okay, so then your time frame. So the time frame you can use. You should always look from the higher time frame to the lower time frame for this purpose. Use a 20-year 1 month, right? It means one candle become 1 bar become 1 month. Right? This is a very long term. You want to see a very long term trend. What is the stock? And then you go to 5-year 1 week. And finally 1 year 1 day, right? So 1 year. Now for investing, you don't have to use daily candles because this is typically where the short-term traders use. But for investing, you just need to look at the weekly candles. Right? Daily candles really for short-term trading. Then candlesticks, just need to understand the blue bar is the open and close price. The close price is higher than the open price, right? If it's a red bar here, you can see here, for example, the open price, rather the close price is below the open price. So this is what it actually means, or in terms of the candles. Okay, so this webinar is short, so I only sort of very simple candlestick analysis. Now, just think of a few at this point in time. Identifying bullish pin bar, right? Or you consider a hammer, right? So on this chart here, where do you see the hammer? You can see, right? This is the hammer, right? Right, very small body, very long tail to the bottom. Bullish, right? Because now for hammer, the color is not important, right? Just take a look. It can be red color or blue color. It's not important. You just have to have the shape. They look like a hammer, right? So this is a hammer as well. Why? Because this shows the rejection of the bearish sentiment. So it's important. It means there's a false break, right? This was during 2018. Okay, so they rejected the bearish sentiment and the bulls take control. So it's important to identify candles like that, 600. So you can see here, when it goes very near the 50 moving average, the blue line, it went back up. So how do you determine the buy points? You use the moving average as a as a basis. When it's very near, it can be a 20 or 50 or 200, right? 20 is short term, 50 is medium term, 200 is long term. So if you don't know which is, let's say you don't know which, because nobody know whether the stock will go to 20, 50 or 200. But based on experience, usually if it hits the 200, later you see, and it's a good stock, right? Long-term uptrend one, you'll come back. So if you see the 50 here, well, we can enter already because it's good time, right? Good position here. So if you don't know whether which one, you just divide. You hit 20, have this formation here, you buy a bit. Or if it drops to 50, okay, then you buy a bit more. If you drop 200, then you should load even more, because if it's a good stock, over time uptrend, drop 200, perfect opportunity, right? So let's look at SPX here, right? So you can see this was the December 18, or rather the September 18, December 18 bear market. So it hits. So was there any signal here to buy? No, right? There was no bullish pin bar, right? So you don't buy it. Okay, then it dropped here. Okay, so no bullish pin bar here, but there's something to learn, the markup bar. Okay, so markup bar is where the body is very big with respect to the range, right? Range means the how long, what's the candle range. For this case, the range is here to here, right? The body must be at least 50% of the entire range. So this is a markup bar. Well, you can argue that there's a markup bar here as well, right? I can say markup bar. Oh, actually not wrong to buy here, because if you just look at this, not wrong to buy here, because it's already come back down quite a bit. It touched the 50. There was a rejection. Just that after that, the price came up. So I was saying, you will never know where the price will go. Nobody can predict the market one, right? So you buy some here, and then when it hits 200 here, if you ask me, you hit 200 here, I buy a lot, because long-term uptrend 200 SMA is very powerful. Right, same. See, here I see it hit the 200, it hit the 50, it goes back. So there's a pin bar here, right? Here, is this 20, 50 right here as well? It goes back. This is a 20, it goes back. So after this time, right, actually nothing to buy already. This is the 2019 period. This was 2019. Right, sorry, this is 20. Yeah, this is 2019, right? This is 2019. This is the 2020 bear market. So there's nothing to buy already, because for investing, you only buy at a certain point in time, right? Once it goes away from here, then you have to be very patient. You have to wait already. Right? This is investing. It's not trading, so you have to wait. And it pays to wait, right? So once they do this sort of thing, and see this is it cut beyond the 200, but it's okay, because SPX long-term uptrend, right? You can do a time series analysis over the last 100 years. It's uptrend, right? So this powerful markup bar I entered a lot in this period of time. So for buy points, I always look at the price action. Yeah. I always look at price action first before anything else, because I want to know what is the stock doing over the long period of time. Okay. So bearish pin bar, right? The other side, right? So identify sell points, right? So this is the bearish pin bar. You can see here. This is a very classic example. Very long candle, and then you have a very small body at the bottom. So this is bearish, right? Very bearish. So sell. If I see something like that, I sell. Right, I definitely sell, because to me this is the market makers manipulation. Right, they manipulate the buyers to buy, and then they sell out. So, and it's very, very bearish, especially if it's a top line, right? You must see where it is at the top, very far away from. If it's here, it'll be starting one. Must be very far away from moving averages. They do something, then you know it's a manipulation to sell. Then okay, so use this stock for example, Shopify. So you see this is the bearish candle here, right? Right, quite far away from the moving averages, right? You can actually take some profits if you want. So it depends. Just some example of showing you bearish pin bar. So this is a bearish markdown bar. Just now is the bullish markup bar, right? Right. This one is the bearish markdown bar. Means it's a red candle, very big body, and the body is at least 50% of the whole range. Okay, so reversal. How do you determine reversal candles? Now, this is contrarian, because now this was Bitcoin, right? Back in 2018, late 2017. When you see things like that, right? Flush, go up, wow, a lot of markup bar, multiple markup bar, and the range is very big one, right? Bigger than usual one. This is actually bearish formation, right? But traders and investors don't know, they think this is bullish, but actually it's bearish. This is bearish formation. When you see things like that, it's bearish. So take note, this is where we see price will reverse over time period. Right, this is for gold futures back in this is 2011. right? So very nice uptrend back then until they do this thing, right? Boom, boom, boom. Oh, this is bearish formation. Because after that, gold prices actually went to a 5-year downtrend. So don't be. You must apply this kind of contrarian mentality in how market works. It also applies to price action as well. Right? So think of this. Same for bullish, right? So this was SPX, S&P 500. So you can see here, very sorry. You can see here, right? Flushes down, a lot of very powerful red candles, like a Ferrari that come down, like that Ferrari. Wow, big red candles, super big one. It's actually bullish formation, right? Bullish. So people think it's very actually bullish. This is where the market makers actually do a lot of traps, trap the bulls, trap the bears at the bottom, right? So but it's actually bullish formation. So take note of how the market is being manipulated. Okay, so buying on dips, like I was saying, how you use that, you only use it for fundamentally strong stocks, right? In a long-term uptrend. Never use it for a downtrend stock, right? Never use it, just remember that. And for investing, you always use weekly time frame, okay? Okay, otherwise, because we know that not all fundamentally strong stocks not all stocks are fundamentally strong, right? Some are momentum stocks, strong in the future, right? Because maybe that earnings are not good, things like that, but their future they might be good. So you can use it also, but they have to be strong momentum stocks. So how do you determine, right? I use IBD, Investors Business Daily. They have this screener, the relative strength screener, above 80. That will show you, right? So if it's above 80, it's a strong momentum stock, right? Then I will also use that as well to buy the stock because that stock may not fulfill the so-called fundamentally strong criteria right now, right? But it's strong momentum against the index. So investors are thinking that this may be a strong stock in the future. But always buy in batches, right? Never buy one shot. So because you don't know where the price will actually go into. And I'll go into detail on how to avoid this value trap later. Now this is what I saw by the strong momentum stock. So IBD will actually give you this thing if you subscribe to leaderboard. Now relative strength here, see RS rating 97, very strong because I look at 80. This is RS, my relative strength. My relative means relative against something, right? It's against the SPX, the market, the benchmark index. So you can see this is let's say this is the March period. So although the price came down a lot, you can see the relative strength here didn't, because SPX also came down, but the Shopify stock didn't come down more than SPX. It maintains its strength. So it shows that the institutional buyers are very supporting it, right? They want to buy into this stock here. So there's a lot of buying momentum into Shopify. Therefore, showing that even Shopify, I mean, we can argue all this all we want. Shopify may be a good stock, not good stock based on fundamental. It doesn't have good earnings, not even profitable, right? I mean, there's no end to it. For us, for me, it's price action. I look at price action. I say, is Shopify I mean, as long as it fulfills the criteria for me, so I use the criteria, but I won't go into detail today. If it's a strong momentum stock, I'll consider it. Right, so you see here, versus 80 is strong. So if you want, you can go to IBD and subscribe to this. You can see here, and it touches the 50, right? Very nicely, bucket bar here, bullish bucket bar. Well, I won't consider this a pin bar, but well, it's, at least but they show some rejection of the bears here. Bucket bar is all the way up. So this is how you look at it. Okay, so where to sell? Now I have this stock called AZPN, which I was glad I could rotate out of it because I didn't want to hold it for long term. I just very medium term investing kind. So more near the bottom. So you can see once it does this, I was saying like the bearish pin bar, and then they have this and that. I sold at this bearish pin bar, right? But 127 somewhere here. I let go of it because to me, the stock suddenly after earnings spike up, it's a sign of a manipulation. And even if I want to hold for longer, I also will let go of some stocks because to me this is very manipulative. I can see the stock may come down, try and recover a bit, but I won't hold stocks like that. If I want to buy back, right? Even I buy back, I'll wait for it to come down to the moving averages again. Right. So price action, sell signals, flush up plus bearish pin bar. Okay, this stock here is at PN. You can see here. See, these market makers always trap retail, right? So this is robintrack.net. This actually shows the this green line here, right? Is the retail holdings. Means how many retail investors using Robin platform are actually bought into this stock over time, right? You can see here. This spike here corresponds to here. So you see so whenever they actually this one when it started the day, right, it actually went all the way up, right? Because that's why it come down, right? So they trap the retailers to thinking that wow, it's going to be very bullish, better buy now. We're going to miss the boat, right? FOMO, better do it now. You can see the holdings multiplied, right? The whole one day went up from how many times? 300 plus 300, more than 2 times, isn't it? More than 2 times. So trapping, laying the trap for the retail investors, and then they this is why it works all the time. All right, so this is a Hertz. I say Hertz here. You can see this as well. Right, spike, spike, spike. Hit, take out the stops here, and then did a bearish pin bar, and then come the way down already. Right. So this is after they announced their bankruptcy. People buy, thinking that wow, better buy. It's very low, very cheap. No Hertz. What's the price earnings so low? Better buy now. You see, this is what they do, right? You see this spike here. Sorry, not here. Yeah, correct. This spike here, right? See, it corresponds with the retail holdings. Multiply how many times? 40,000 to 180,000. 4 times, right? They trap the retailers inside, right? Let them get trapped, and then they can take off. So this is how it works. This is how markets are basically manipulated. This is another discourse example, right? So I want to show you because this is how it looks like. This is how it looks like late afterwards. This appeared for a few hours. Like they let the retailers go up, trap them. After they find enough of them get trapped already, then the liquidity providers push it down, right? And they push it down. You can see here the trap. When they lay the trap, you see the retail investors also all inside already, right? In the way the trap, and they close it down. So all the retailers all here, all get stopped up, all lost money. So okay, so now I'm going to after I'm going to price action. Now I understand why price action is important. To be a successful investor, you need to know price action. Like that's the need, because then you can know how to basically market reversals and know where to buy and sell. Okay, so now this is technical analysis. I hardly use it anymore because through my experience, it's not consistent. It doesn't use consistent. It's also really, I really use it. But if you want to know, there's so many indicators out there, right? I track a lot of them. But if you really want to have a bit of guidance, then you can just follow Bollinger Bands and stochastics. That's good enough, right? Don't have too many. Too many, you'll be very confused. So you can see here the band here, right? This is the Bollinger Bands. The upper band, this is the lower band. So whenever the price hit the upper band, right, is considered overvalued, right? Overbought. Right, so based on the band theory, it should come down. But not all the time, right? Not all the time you can see. So it's not foolproof. Right here, I see you hit the band, you're still going up. So they cannot be used on their own. You want to use it, you have to use it together with other kind of confirmation, right? So this just give you an idea. So when it hits the lower band, it's oversold, right? So you look at oversold. So give you an idea. Stochastics. These are the line 80 and 20. This 20. So whenever it's above 80, it's overbought. Right? Means that the stock may come down, but don't know when. Just that it may come down. But whenever it hits the 120, it's oversold, right? The stock should go up, but don't know when, right? So this you can't use them as buy and sell point, because through my experience, it's not consistent. But I give you an idea. But just not how to use it anymore. You can choose not to use it also if you don't want to. But if you want to have an idea of using delicacy, you can consider it. Okay, so how to avoid value traps? Now, value traps is the typical cigar by investing. Okay, so or some people call it deep value stocks. Okay. Very misleading. Deep value stocks. Now, just take note, Buffett has not moved away from this. But he preferred to buy a wonderful company at a fair price than a fair company at a wonderful price. So using Hertz, for example, I was saying that it's a value trap, right? Because first, before anything, I always look at the price first. What's the price doing? So this is a long-term chart, weekly candles. The price is the downtrend, right? Because 20, this is a 20, it's below the 50, and below the 200, right? It's a downtrend. It's a downtrend stock. You know what? Why? I mean, yeah, it's cheap. Price earnings is very low, blah, blah, blah. But why want to buy such stocks, right? It's very cheap, but it's a value trap to me. Okay, so just use these examples as well to consider. First, you can see here, right? Very cheap, PE 3.1, right? Even this is now, but even previously it was also below 10. You know the S&P historical PE median is 17 times. This is below 10. So based on PE, it should be very cheap, right? Big value, but it's a value trap for me. So I will never buy it. Singapore Airlines. So because friends were asking me about these stocks, so I was telling them. Singapore Airlines, I mean, they're telling me after COVID, you cover and things like that. So I was telling them, before COVID, it's really not doing well. So what makes you think after COVID it will do well, right? So you can see value trap, right, quite clearly. Right now, 20, below 50, below 200, and it's been like that for a long time, right? So why buy into Singapore Airlines? In fact, I traded it. I bought it when this was the weekly chart. So I did a short. This is okay for short-term trading, right? Not for investing. So I found opportunity. I traded it. I saw the manipulation. So I bought it at 3.7. This was back in May, right? And then I sold at 4.4. So after I let go of it, it came down. See, right? After I let go of it, it came down. So because it's not investing for. So why you can see Singapore Airlines, look at that revenue per share, right? It's not, remember, retail business revenue per share should be consistently increasing. Look at that, it's all over the place, right? And then the gross margin, see, okay, one thing that I would say Singapore Airlines, like gross margin, they have been improving, right? Improving a little bit, right? They have started to improve over the last few years, and I think that's the reason why Buffett bought into airlines as well. Thought that the margins are getting better. So goes to Buffett, right? Economic mode is also based on margins improvement, right? If your margin is improving over time, it means that you are actually gaining economic growth. So perhaps I don't know. I just guess perhaps that's why he wanted it. But I mean, I'm not bad at when I see this immediately. First criteria, is it predictable? Oh, I see it. Right, then of course there are all other things, right? Price in the first thing, price and long-term downtrend. That's my first criteria. Right? If I see long-term downtrend, you can tell me all you want. Price is cheap. I don't care. I'm not going to buy it because price is not telling me. At the end of the day, I make money from price, right? Not from price earnings. So this is what was this? This ROE. So you can see ROE is very inconsistent over time, right? The last 10 years or last 15 years. And what's worse, their debt to EBITDA ratio is very high. This is how I look at the debt, right? This point in time is 5. So if it's more than 4, it's unstable. Although it's previously it's not so high, but even with so much debt, it's an ROE that can generate over time. It's not high, right? You can see ROE is so inconsistent, 2, 2, then 5. ROE should always be more than 15. Instead of 15, it's not a good business. Right? So look at the negative point, downtrend, revenue not consistent. Yes, okay, this is a plus point. ROE less than 15, EBITDA is more than 4 times. And what's the worst thing? It doesn't generate cash, it bleeds cash, right? So you see that this is the earnings per share. This is the free cash flow. Right, so it doesn't generate cash. At the end of the day, you must understand you need the business must be a cash generator. So negative. So there's so many negative points. Why you want to buy into SIA? It just doesn't make sense. So I think I managed to cover quite a bit of detail today. So at the next webinar, I will go into how to look at high momentum speculative tech stocks, deep dive into some of it. And then I will focus on what are the future profit drivers. Like I say, it's speculative, so they don't have profit drivers now, right? So, but they in future, I mean, going forward, what are the profit drivers that will drive their growth? And which are the ones just purely hype, and which are the ones are potential, right, that will gain economic mode in future, and where there are buy points at this point in time. Okay, I'll just leave this for any question and answers that you have. You can put it in the chat group. Otherwise, you can leave it in the feedback, so we can talk again. But before I end it, I just want to say that currently the stock market, whether it's on Nasdaq or the S&P 500, there really isn't a lot of good buy points now. Right? So you have to be very selective. Sometimes once in a while they have, I'll be adding stocks once in a while whenever I see buy points. But on the whole, this is the minority, right? There's no good buy point. You have to wait for a while. But the stock market is not looking to correct like what we saw in the COVID, based on what I can see in the price. And even if there's some retracement, it's just to shake off the weak hands, and then it will come back again. So you got to wait for that. Investing, you always must be patient. Spend time digging into stocks, new companies, and look at the price. So this is how you determine the right price. Yeah.
Okay. Thank you, Mr. Jeremiah, for sharing, and thank you everyone for participating in this webinar. Before we conclude, are there any questions that you would like to raise regarding the webinar? You can type it in the chat box below. Yeah, if not also, before we end this webinar, we would like to receive your feedback also. Please fill in the feedback form so that we can send you a copy of the slides. Yes. You can scan the QR code and fill in the feedback form. Thank you.